So, Kevin, I'm going to call you to start, and then you can.
Okay, welcome to the June 21st, 2023 NYCERS and BIRDS joint investment meeting. Melanie, will you please do the roll call? Kevin Liu, representing Mayor Adams.
Comptroller's Office.
Allison Hirsch, representing Comptroller Brad Lander.
John Dorso, alternate for Control Lander.
Public Advocate's Office.
Elizabeth
President
Guzman, representing Jamani Williams.
Karina Lozada representing Borough President Antonio Reynoso.
Just point of information, you need to press the push button on the mic to talk. Oh,
Is there a way to keep the mic on? You have to hold it? Okay. Public Advocate's Office.
Elizabeth Guzman for Public Advocate Jamani Williams.
Borough President Manhattan. Borough President Brooklyn.
Karina Lozada for Borough President Antonio Reynoso.
Borough President Bronx. Borough President Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island. International Brotherhood of Teamsters.
Lawrence Bosley and Judy Loby for President Gregory Floyd.
Transport Workers Union.
Okay. Dave Katzman for TWU Local 100 President Richard Davis.
And District Council 37. We have a quorum.
Thank you very much. And I believe we have a couple items for the public session. Okay, sorry. Will the BIRDS staff please identify yourself for the record?
Absolutely. It's Antonio Rodriguez here from BIRDS. Trustees, we have Allison Hirsch, John Dorso from the Comptroller's Office, and Anthony Giordano representing us at the meeting today. We will take care of these matters at our first in-person meeting, executive committee meeting since 2020, tomorrow at 1 p.m. at 55 Water Street.
Thank you. So I believe we have a couple items for the public sessions. So John, would you like to hop in?
Great, thank you. So we have a quarterly presentation and a risk report that Steve Meyer, our CIO, will be delivering. Steve's actually going to use the podium rather than have to press this down for his entire presentation.
Good morning, everyone. Is this on? Got it. Well, good morning and welcome, everyone. I'm just going to give you a quick update on what's going on in the U.S. and global economy as a backdrop to our performance update for the first quarter of this calendar year. Kate, could you go to the first slide, please? So obviously, inflation here and abroad still dominates the headlines. The U.S. CPI is down over half of its prior peak in June of last year of 9.1%, but it is still very high and elevated. The Fed's preferred inflation measure, the core PCE deflator, has been sticky in the mid 4% levels. And remember that the Federal Reserve's target for inflation is only 2%, so it's still very high. On the next slide, just to look at U.S. inflation in particular, you can see that the core PCE deflator in yellow is at 4.6%-ish, and for the last 12 months, it's been sticky in that 4 to 4.5 to 4.75 range. CPI's moved down nicely, as I said, since the June peak of last year, 9.1%. On the next slide, This is a look at inflation around the world. We did have an inflation report this morning. In dark gray, you can see the UK inflation level. It's been very sticky for quite some time. It actually came in this morning at 8.7% CPI, higher than expected. That's the fourth consecutive month where that number's come in above expectations. So obviously some more work to be done in terms of fighting inflation there. We have a Bank of England meeting tomorrow. The market's priced in 25 basis points, but it's given today's economic release, it's looking at potentially maybe 50 basis points rate hike tomorrow as well. The other two lines you can see in red, sorry, Kate, the US continues to move down earlier, like I said, in the Eurozone, similarly moving in the right direction. On the next slide, next page. U.S. employment is still very strong, near historical lows. The average monthly job creation over the last 3 months has been above 300,000 jobs created. For the Fed to adequately slow the economy, that number should probably be closer to 75,000 jobs created per month. So again, much stronger than the Fed would like to see. The unemployment rate for May was 3.7%. That is just off of its 53-year low of 3.4% reported in April. So again, a very strong labor market here in the States. Having said that, weekly initial jobless claims are starting to trend higher over the last 3 or 4 weeks. So that may be an indication that the job market is just beginning to slow here in the States. On the next slide. There's actually 2 other measures of employment in the U.S. In yellow on the top, you can see that's the labor participation rate at 62.6%. That's moved up nicely since its very low period at the peak of the pandemic. It's still about 1 percentage point below where it was pre-pandemic. So still more work to do. The fact that the participation rate is artificially low could be exacerbating the labor shortages we have in certain sectors of the U.S. labor market. On the next slide, U.S. economic growth in the first quarter was a paltry 1.3%. That was actually revised upward. And the fact that it's positive means we continue to grow. The U.S. growth has been supported by a resilient consumer and strong service sector spending throughout the economy. China's reopening was also met with great fanfare earlier this year. Expectations were that it would be an engine for growth in Asia and perhaps for the entire world. The expectations initially were 5.5% to 6% GDP growth, but so far this year they've underperformed those expectations at just slightly below 5%. And I know that the central bank last week actually cut rates and announced a couple other stimulative measures to support economic growth there. The next slide is a look at the consolidation of low levels of economic growth on the far right-hand side. As I mentioned, China just below 5%, the US at 1.3%. The UK has been flat-ish. Japan has been flat as well. And the Eurozone has actually just entered into a technical recession. On the next slide, something a little closer to home. A look at the return to work. Across the US, it's been a very slow process of having workers returning to the office. Here you can see New York office return is about 48% of pre-pandemic levels. Still perhaps more work to be done there with implications for tax receipts in the city of New York. On a similar vein, the next slide looks at actually ridership. Subway, I actually ride the subway both ways to work each day. And I can tell you that I slowly start to see more and more people with the exception of Fridays. But that blue line up top indicates that we're about 70% of where we were pre-pandemic in terms of subway ridership. The green line below is actually the San Francisco BART system. And there they are slightly below 50%. So again, that process of normalization following the pandemic continues, albeit at a relatively slow pace. On the next slide, in June, the Fed actually paused or skipped its rate hikes after 10 consecutive rate hikes over a period of 14 months. The Fed's summary of economic projections, however, their dot plots indicate 2 more hikes are likely this year. And it looks as though July is pricing in the potential for The high potential for another rate hike in July and followed by perhaps a final rate hike in September. As I suggested earlier, the Bank of England and the ECB continue to raise rates, official interest rates, as inflation has been quite sticky on the upside in the Eurozone and the UK respectively. On the next slide, just to look at the dramatic increase in rates on the far right-hand side. Notwithstanding the fact that we had a recent skip or a pause in Fed activity in June, the rate remains 5% to 5.25% target Fed funds. That's an increase of 500 plus basis points in a 14, 15-month period. So significant rate hiking cycle that we've experienced, the most aggressive one we've seen in 40 years. Below that, you can get a look at the financial conditions. They continue to tighten. They were, however, slightly tighter in the middle part of 2022, but they still are certainly above where they were at the end of 2021 before the market correction last year. On the next slide, just a look at historical comparisons. That red line is pretty jarring in terms of the increase in rates, notwithstanding the skip. That occurred over about a 420-day period. So again, an aggressive rate hiking cycle. I'd say the most of that recent hike and cycle is probably not yet fully felt throughout the economy. And you've heard me say before that monetary policy acts with a long and variable lag. And we continue to see evidence of that in the economy today. On the next slide, U.S. Treasury yields have been moved up quite significantly in the second quarter of this year. This is due to the Fed policy rates moving higher. Again, those two hikes we saw in the early part of the quarter. Economic growth and sticky inflation. The two-year yield has actually risen by about 100 basis points since early May. And that is the rate that is typically most sensitive to Fed policy changes. And credit spreads and high yield and investment grade have come down since widening during the regional bank challenges in the first quarter, spilling over into the second quarter. But I believe that they will probably widen further in the future, and I'll talk a little bit more about that in a moment. On the next slide, just a look at where we are with the yield curve and interest rates. So I think the most interesting part of this slide is on the far right-hand side, where you can see the inversion of U.S. Treasury yields between 2-year and 10-year yields. Typically, 10-year yields would trade at a premium or a higher yield than 2s. Right now, that's not the case. And as of this morning, 2-year yields were about 97 basis points above the 10-year yield. That basically tells us that the market is pricing in expectations for a recession at some point in the future. On the next slide, just a look at the 2s and 10s. The 2s are in white. As I mentioned, those yields have moved up about 100 basis points from where they were in early May. Less dramatic move in rates for 10 years in green, but still you can see they've trended higher very recently. On the next slide, a quick look at credit spreads. Credit spreads in yellow and orange, rather, or yellow, whatever that color is, those are high yield spreads at 408 basis points over comparable U.S. Treasuries. I should mention that they started 2022 below 250 basis point spreads and had been wider. And you can see below that in white, those are investment grade credit spreads at 133 basis points above comparable treasuries. So spreads are slightly wider. I'd say if you're expecting a recession with a possible increase in default risk, those spreads should widen even further. On the next slide, the U.S. dollar remains strong, actually very strong. Economic growth and the interest rate differentials in the U.S. certainly favor the U.S. dollar. And the U.S. dollar continues to benefit from its reserve currency status, as well as its flight to quality status. Remember, we still have a ground war in Europe, and that continues to help support dollar valuations. On the next slide, just a look at the three main currencies that we tend to talk about: the euro, the pound sterling, and the Japanese yen relative to the dollar. Just to provide some context, the dollar was even stronger last year. So at its peak, each euro only purchased 97 cents, whereas it buys $1.07 now. Each pound sterling only bought at its peak $1.03. Its peak in the dollar, rather, $1.03. It's now $1.24. It's actually slightly higher today at 127. And each US dollar at its peak bought over 150 yen, and that's now moved down to just 138. So it's weakened a little bit, but still remains very strong relative to where it's been historically. On the next slide, U.S. fixed income investments continue to be attractive for long-term investors, given the higher base rate interest rates and wider credit spreads, even though they can continue to widen. And the U.S. and global equities have rebounded nicely in 2023 year to date. We also have a situation in the markets that are referred to as the debt ceiling aftermath. Well, right now there are some dislocations that are beginning to occur on the short end of the curve. Going through the debt ceiling crisis, remember the Treasury enacted what were called extraordinary measures beginning in January when they hit that $31.3 trillion debt limit. Their Treasury general account actually was dwindled down to about 40 billion in outstandings, where it is typically between 600 and 700 billion. So right now the Treasury is in the process of replenishing that account, and the expectations are you'll see perhaps as much as $1 trillion of issuance in U.S. Treasury bills, which may provide some upward pressure on short rates, bill rates, repurchase agreement rates, and potentially bank deposit rates, but I'll talk more about that in a moment. On the next slide, a look at world equity markets. And the good news here is on the right-hand side, you can see the year-to-date change in the year-to-date in the U.S. dollar currency. So there's a lot of green on that slide. You can see if you focus on the NASDAQ 100 composite index, it's returned 31.56% as of late last week, which is a great rebound from where it had been last year. But all manner of equity markets, for the most part, are up. I think the other interesting thing is if you look at towards the bottom right-hand side, you can look at the Nikkei, Japanese yen related. You look across and you can see that the Nikkei index is up 29% and change year to date. But given the fact that the yen is weakened against the dollar, the US dollar returns when we repatriate those and account for those in dollars is just a 19.81% return. So that's how you read this chart, and that's how you see the valuation in the dollar fluctuating and impacting your returns in non-US equities. On the next slide, a look at 10-year US sovereign bond, 10-year sovereign bond yields, including the US. Global sovereign yields are generally lower for the year, which means bond prices are up. I'd say the one big exception there is the UK pound sterling, and their gilt bonds are actually up significantly, about 74 basis points in yield year to date. And that's because of the stickiness of the inflation and the fact that there's been a lot of rate hikes and perhaps several more to come. On the next slide, a quick look at market volatility. On the left, you can see the VIX, which is an indication of equity price market volatility. It's been somewhat muted this year. Typically, on average, the VIX is around 19. It's been trading below 15 for the last few weeks. And as of this morning, it was trading below 14. So again, not a lot of volatility in equities right now. I'd say the better story, the more interesting story is on the far right-hand side. That's the MOVE index, and that's an indication of implied volatility in U.S. Treasuries. And the volatility in the MOVE index has been elevated year to date for a number of reasons. You've got Fed policy uncertainty, and the Fed stopped and paused and skipped, and now the dot plots reflected another 2 potential hikes. You've had debt ceiling concerns and uncertainty driving volatility as well. You've had economic growth and recession risk uncertainty. And lastly, you've had sticky inflation, as I mentioned, the core PCE deflator. In terms of market returns, which is something that's probably more interesting to all of us, on the left-hand side, you can see that you've had a nice recovery from the lows of 2022 and 2023, with equity prices moving higher in terms of the Russell 3000, the MSCI EFA, and the MSCI emerging market indices in red. On the right-hand side, that's a look at the, it says Barclays. It's actually technically, I believe, Robert, correct me if I'm wrong, it's now the Bloomberg AG. The Bloomberg AG year to date, you can see how incredibly volatile it's been over the last 2 years, and that low point it touched in 2022. But we looked at this morning, Robert and I, on Bloomberg, and actually the Bloomberg Ag is up about 2.4% year to date. So a nice recovery in bonds, notwithstanding the volatility we've seen in yields. On the next slide, just a really interesting look at U.S. equity markets. Here you've got the Russell 3000, which is really the aggregate of the Russell 2000 plus the Russell 1000 returns. The Russell 1000 is indicated in green, and those are large cap stocks. Large cap stocks have outperformed small cap stocks in red. However, that recovery, that outperformance has been driven by only a handful of stocks and some interesting points. The 7 large cap stocks that have really driven the bulk of the performance on a relative basis have been Apple, Microsoft, Alphabet or Google, Amazon, NVIDIA, Tesla, and Meta, formerly known as Facebook. The returns for these 7 stocks are anywhere between 40 and 180% year to date. It's another interesting statistic that Apple's market capitalization now exceeds that of the entire Russell 2000 index, which is really quite remarkable. But there's just an indication of the dislocations between large cap stocks, growth stocks, tech stocks relative to small caps that tend to be a little more domestically focused. On the next slide, some points about recent news. We had regional bank disruptions earlier in the year. Now things are calm. But I can't promise they will continue to be so. I actually believe that bank consolidation is coming. You've got significant probability of an impact on regulatory costs and a need for stronger deposit base among banks. And if you look at where we were 25 years ago, around 1997, we had 13,000 banks in the United States. We now have 4,000, which still is very high relative to global standards. So, and some would make the argument that we're an overbanked economy. Others would say the fact that we've got regional and small banks really supports local businesses. But I do think that you'll probably see some consolidation. More to that point in the next slide. So look at the banks' percent of cumulative assets. You can see the two with the arrows, the black arrows on top, are the First Republic Bank of California, and secondly, Silicon Valley Bank. The banks to the right of Silicon Valley Bank are probably at some risk. They're at a minimum, they're less likely and less willing and able to make new loans. So we'll probably see tighter credit conditions as a result of what's gone on earlier this year. These banks are probably at risk again due to increased regulatory costs, the increase of deposit costs, and I'll show you a slide that's really interesting in a moment, which equate to lower net interest margin and lower profitability on the part of regional banks. On the next slide, I find this slide to be incredibly interesting. What you basically have here are the Fed fund target rates in green and the rates that are paid on checking accounts and savings accounts at banks. And you can see that they barely budged over the course of time. But right now you can see they're starting to lift off. If you look at the far right-hand side, as short-term US rates have risen, Treasury bill rates have risen over 5%. Money market mutual funds can now yield above 5% with the backup and increase in Fed funds. They compete with bank deposits, and bank deposits on average are about 25 basis points. So if you're an individual and you've got money sitting in your checking or savings account, right now you can probably do it off your iPhone, simply move over to another instrument, either buy a T-bill or move into a money market mutual fund for what would be probably close to a 500 basis point pickup in yield. And I think that's why we're going to see more challenges for banks as those deposits flow out, potentially into other instruments. On the next slide, also food for thought. Commercial and industrial loan, the availability is much lower today, and that's indicated in green. This is kind of a complex slide, but if you look at the green line and use the left-hand side, that actually indicates the percentage of banks in the United States that are tightening lending standards, meaning that there's a reluctancy on the part of banks to continue to make loans. And the takeaway from this slide is if you look at the high yield spreads in blue, this indicates they're slightly below 500 basis points. And we talked about earlier, the spreads are probably around 408 basis points today. The indication is as credit conditions tighten, high yield spreads should widen. And I think we'll probably see that over the coming months. We'll probably see that for a couple of reasons. Firstly, just supply and demand technicals in the market, but also as we approach the potential for a recession, there might be a corresponding increase in defaults. Now moving on to first quarter performance, which is what we're all here for and interested in. The first quarter performance, you see Q1 2023, it's all green. So it's pretty good rebound from, again, a very challenging and difficult 2022. To the right of that, you can see the one-year returns continue to be in red. So last year was such a challenging market, notwithstanding the fact that we've had a nice rebound from the lows that we saw in 2022 and early part of 2023. There's still more work to be done just to recover those negative prints or those drawdowns we saw last year. On the next slide, a look at NYCERS net public market returns by strategy. You can see the assets under management listed. So for example, US equities, there's about a little over $21 billion in holdings. The 3-month return for the first quarter has been about 6.5%. So again, a nice recovery from the challenges we saw last year. And the good news across all public asset classes, including cash, is that it's all green, it's all positive. Same story here though, the one-year returns continue to be, for the most part, negative with the exception of cash. On the next slide, a look at NYCERS net private market returns by strategy. Here in the one-year space towards the top, you can see private equity returns for the one-year period are actually down 3.3%. And that has to do with the mark-to-markets that have occurred at the end of last year. Again, private assets tend to be marked only 4 times a year, so there's a little bit more of a smoothing process. These marks are as of December 31st. So again, some give back in the prior performance that we saw in private equity, but the other private assets, for the most part, for across the board in the one-year space, are all positive still. Looking down towards the bottom chart, you can see that NYCERS total plan returns for the 3 months ending at the end of March are up 4.5%, which is a good result, again, on a very short-term basis. I think the more interesting aspect of this slide, though, is the public market equivalent, the 65-35 portfolio, is actually up 6%. And the takeaway there is that the private assets and private equity in particular, given its overweight in your portfolio of about 2.4% right now, is pulling down the performance to some extent on public markets. Again, due to that lagged impact of the marks that occur throughout time. I think the more important takeaway, though, here is on the far right-hand side, the 5-year returns, the 3-year and the 5-year returns are all green and all positive. On the next slide, a look at NYCERS total plan attribution for the first quarter. You basically, unfortunately, the portfolio underperformed its policy index returns by about 40 basis points. And again, that had to do with the slight overweight in private equity and the performance, the negative performance relative to its public market benchmark for the quarter. On the next slide, a look at the net public market returns by strategy. And you can see that there in basis points, US equities have underperformed the Russell 3000 by 65 basis points. In the non-US space, we've outperformed the index by 376 basis points and down the line. Convertible bonds is the other area where you see red at 166 basis points. And this is because this has been a risk on, meaning asset prices generally going higher in risk assets, and the management of the converts in the portfolio tend to be more conservative, which drove that underperformance. The total NYCERS performance, however, for the 3-month period was a negative 44 basis points relative to its benchmark. And that includes, again, those private asset mark-to-market to the end of the year. Excuse me. Next slide. A look at the private market excess returns and basis points. And even though I reflected that you've seen some mark-to-market reduction in returns for private equity in particular, relative to the Russell 3000 benchmark, private equity in the one-year period is outperformed by 1,500 basis points. And basically all manner of private assets have done the same in terms of outperformance, with the exception of non-core real estate, which tends to be more higher risk and potentially be slightly more volatile. So that's underperformed by 200 basis points. But again, I think the more important measures are to look across and look at the not so much the 3, but the 5 to 10-year outperformance in basis points. And it's all green out there, which I think is very positive. On the next slide, just a quick look at the rebalancing activities for the first quarter. So obviously, you've got a need to make benefit payments as well as support private market capital calls. So most of the activities in the first quarter were really designed to raise cash. There was $755 million in cash raised, again, to meet those capital calls and those benefit payments, as well as John Mercerberg rebalancing the portfolio in the international fund-to-fund space. And with that, I know I've thrown a lot of information at you in a short period of time. Are there any questions? Anything I haven't touched on?
All right. Seeing none, I just want to remind folks, if everyone online has any questions, please use your hand signal. Not seeing anybody, I just want to remind folks that Steve is available between meetings in the event that there's questions about things going on in the market, things going on about the portfolio, or just general investment questions regarding the funds. Steve is available, as well as the members of the team, to address any of the topics that you see today.
Great, thanks.
So next up is Ed Berman, who's going to give us a risk update. So we'll turn it over to Ed.
Good morning. Great to see everybody in person. I think the first time I see some of you live. So we'll be talking about risk today, and you just heard Steve's presentation go over performance and over the challenges faced by the economy and by the markets. And I think the most important question we have on our minds, so what does it mean for your portfolio? And broadly speaking, the question is everything functioning as expected? Is everything functioning as expected today, and will your portfolio perform as expected going forward? And obviously, your portfolio is a complex, mature portfolio. So you have about $49 billion in assets. There are about 116 public managers, 344 private funds, and you're holding about 13,000 individual stocks. So it's a lot of complexity, a lot of moving parts. On top of it, there are markets, the economy, geopolitics, individual managers making decisions, BAM staff making rebalancing decisions. So a lot of people touch your portfolio, and we call it risk, right? And risk is not a bad thing. We want risk because that's how we generate returns. So risk is good, but risk needs to be consistent with the investment policy. So we'll try to answer 2 questions today. First of all, is the risk exposure today consistent with what you intended to be? And secondly, going forwards for tomorrow, will your portfolio perform as you expect? And first of all, much like I mentioned before, we need to explain what we mean by risk. And it's actually not a simple question. There's no unique way to define risk, but for the purpose of a multi-asset portfolio, much like in the previous quarters, we define risk in terms of expected performance. And simply put, we, much like the 2 measures of performance, we talk about total return and excess return. They're both important, but they assess different parts of the returns. Much the same, we introduce 2 measures of risk. So there's an expected total return for the next 12 months. And that's what we call absolute return total risk. And then there's the expected excess return over the next 12 months. And that's what we assess as active risk. And the key word here, expected, right? Because we don't know the future. All we can do is just put probabilities, the expectations around it. So we define total risk as the expected future returns over the next 12 months with a 68% probability. And 68 is just normal distribution. That's why this magic number. And much the same, we define the active risk as the expected excess return for the portfolio over the next 12 months, again, within a 68% probability. Can we have the first page, please? Thanks, Kate. So you can see the numbers at the bottom right corner of this table. You can see the total risk is 12.8% for the quarter. It's slightly down. And the active risk is 2.2%. Probably these numbers by themselves do not give you much comfort. Are they big numbers, small numbers? Is reason for concern. So number by itself is somewhat meaningless. So we'll try to follow the asset allocation and try to follow the market to make sense out of it. So first of all, we start with what we call market portfolio, and that's in a column number 1 in the table. And the market portfolio is a simple blend. It's a 65% of the MSCI equity and 35% of Barclay US AC. So that's, we selected this model portfolio to be as close as possible to your actual portfolio, to actual allocations. And the stock bond split, the stock allocation, ultimately what determines the level of risk and the returns for the portfolio. So you can see under the portfolio construction section of this table, the main dimensions of risk for this market portfolio. Obviously, 65% of equity allocation by construction. You see interest rate duration of 2.2 years and credit spread duration of 1.3 years. So this is our baseline. This is what the markets are. At the bottom of the table, you can see what it means for risks. So for this market portfolio, the total risk is 12.3%. You see the total risk came down slightly for the quarter, minus 0.2%. And we know this is the result of the market action. So when the risks came down in the market, and you can simply know by following the VIX index, which is a measure of volatility. Just to give you a point of reference, on average over the long period of time, VIX tend to be around 20 points. Like in October 22, about what, 3/4 years ago, VIX stood at 34 points, was elevated. In the end of Q1, it came down to 19. It's about average. Just point of reference, as of today, VIX is around 14 points, very low. It's an interesting question why, but that's will take us away from this presentation. So we know the risks coming down. We know that the risks in the fixed income markets, measured as MOVE index, are also down. So it's not surprising that our market portfolio came down in risks. So it's important now to keep in mind this is our baseline. And related to this, we have the second measure of risks here. You can see beta to the S&P 500. So the total risk gives you a measure of the expected performance over the next 12 months. It's more long-term measure of risk. The beta to the S&P, it's a more of a short-term measure. It simply means how much your portfolio will move to the change in the S&P, right? So simply put, beta of 0.61 means that for 1% rally in the S&P, your portfolio will gain 61 basis points. Again, we show these numbers here as a base point for analysis. So the next step, moving towards a policy benchmark. So policy benchmark includes the asset allocation, where we split this broad market portfolio into 11 individual buckets, individual asset classes. So you can see that the policy benchmark has a slightly lower equity allocation, but it's broadly aligned in terms of interest rate and credit spread duration with the market portfolio, maybe slightly less. That's the asset allocation. So what it means for risks, you can see the risks came down. You see the total risk at 11.7% is down from the market portfolio. Part of it is low equity allocation, but large part of it is actually the diversification. That's exactly what we want from the asset allocation. We want more exposure to more asset classes, more sources of returns, but lower risks. So all it tells you is asset allocation is working, and obviously we're now reviewing it, but that's we talked about last time. You also see that the beta to the S&P, a shorter measure of risk, is also slightly down, 0.59. It's not surprising. It's a low equity allocation. So no surprises. And finally, we're moving towards your portfolio. It's column number 3. And that's where everything comes together. It's the asset allocation, it's the choices made by the managers, it's the rebalancing, the cash flows, it's all the technicals that go into managing the portfolio. And first of all, on the portfolio construction section, you can see that the equity allocation is broadly in line with the benchmark. There's some short-term fluctuations, but very similar to the market portfolio. You can see the durations are closely aligned with the benchmark. It's not surprising, it's by construction. Your portfolio is matched very tight to the benchmark. But most importantly, what it means for risks. So that's where we arrive to the punchline. You see that the total risk level at 12.8% is very closely aligned with the benchmark and with the market portfolio. You see that the risk came down for the quarter, and we know it's because of the market action, again, as we compare against the benchmark. And here we introduce another measure of risk, active risk. And that's the measure of the excess return. It's everything that your managers do. It's the illiquidity premium. You can see that this active risk is 2.2%. Right? And it's an important number to keep in mind because that's what will determine your returns and the exposures taken in the portfolio. And finally, on the right-hand side of the page, we show 2 charts. So that's where we see the evolution of these risk measures over the last 12 months. So what do these charts tell you? Starting with chart number 1, which is evolution of the total risk, you can see that the relationship between these 3 portfolios stayed very steady over the 12 months. There's some short-term fluctuations, but broadly speaking, you see that your portfolio is running at slightly higher risk level, and it's structured by construction, as expected. We'll see the reasons why. But most importantly, you see this relationship is steady. You see that the risk levels came higher early in the year. It's peaked around the end of last year and started coming down. That's exactly as you would expect if you follow the VIX index, the MOVE index. This is just market action. It's not something that's happening inside your portfolio. So what are main conclusions from this page? And that's, I would say, probably one of the most important pages in the presentation. It's like the punchline to the whole story. So first of all, your portfolio is aligned with the benchmark. Why I say that? Just look at the chart number 1, tells you the entire story. This is by construction. That's what we do at BAM, and that's how you want it. So that's a good outcome. We know that the performance of your portfolio is driven mostly by the markets. And why I say that? Simply because the active risk level is much lower than the total risk. So most of the performance will be given by the asset allocation, by markets, and this little bit extra for managers, but the keyword little extra. Again, this is by construction, and that's as expected. And finally, your portfolio is running at a higher risk than the benchmark. And that's an important conclusion because obviously in the up market, in the rally, it will deliver a higher return. Unfortunately, in the down market, it also means that you probably realize slightly more drawdown than the markets. Again, this is by construction, but the reason I like this page, this is a single punchline that tells you everything is fine in your portfolio. But you can say it's a little bit of a crude tool, a lot more things happening, and I would agree with this. We need to dive a little bit more into details to see what's happening within the portfolio. And I should mention that 2 measures of risk, total risk, active risk, so we'll take them in stages. Let's start with total risk as the most important for your portfolio. So, Kate, can we have the next page, please? So, as I mentioned before, your total risk level is 12.9%. We define the risk in terms of the performance, but what drives it is the asset allocation and the market. So the chart you see on the left must be very familiar to you. This is the asset allocation or market value exposures in your portfolio. So what you see here are the actual allocation, actual exposures. There is no parking place adjustment here. And what you'll notice that these exposures are very closely aligned to the benchmark. Again, there's no accident. That's something we actively do within BAM. The largest allocation is obviously public equities at 44%, with US equities being the largest bucket at close to 28%. So no huge surprises here. Please notice a small, thin red band of cash at 0.8%, which is clearly an off benchmark, but an important allocation. The chart you see on the right is probably less familiar. So that's what we call risk allocation. So what you see here are the risk contributions to the total risk of the portfolio. A few things jump at you. So first of all, this chart looks very different from the asset allocation. You see that the blue band, the public equity band, widened dramatically. Now public equity is 63%. US equity is close to 40%, much more than what you see based on the asset allocation. Private equity obviously widened significantly, and it's simply a function of market volatility. We know that equities, be it public or private, come as a much higher risk level. Public fixed income now shrinking to almost 7%. So it's an important chart to keep in mind. So this chart gives you an intuition of how a performance of your portfolio will evolve over the time. So it gives you potential sources of returns, but also potential pitfalls, potential sources of drawdown. Now, you may say me that this intuition doesn't connect with your other intuition from observing the performance of the system. You do not see equities dominating to that extent. And the answer to this is rebalancing. So if we stop rebalancing, if we stop doing it religiously, that's how your portfolio would look like. You'll end up with an enormous allocation of public equities. And the importance of BAM does on a weekly basis and monitoring it daily is to prevent unnecessary risk concentration in your portfolio. That's an important messaging here, that fixed income is a source of carry, but probably not likely to have a significant detractor from the performance. What we need to watch, obviously, public markets, public equities, and fixed income. So I keep saying that risk is performance, expected performance. And from this perspective, it's important to connect the two. So can we have the next page, please? Thank you. It's important to connect the performance with the risk, with the projected model risk. First of all, it's an affirmation of the integrity of our risk models. And it's important because here I'm giving you projections, framing expectations. What if our risk models are incorrect? Secondly, and probably more critical, it's a check on the asset allocation. So obviously we do asset allocation once every 3 to 5 years. We're now in the process of reallocating the assets. But it's something we keep watching on a regular basis. And if something goes wrong, we're obviously in a position to raise our hand and make it known. So what you see here, just to walk you through this chart, the vertical bars represent the risk forecast. It's scaled to 3 months. And much I keep saying, risk is performance. Performance can be positive or negative. That's why these bars are symmetrical, but they go up and down. The yellow dot, or the yellow triangle, represents the realized return for the asset class for the quarter. What we're looking for is for this triangle to be within the range of the forecast, within the range of the risk forecast. Anything outside this range is a potential reason for concern, or potentially a flag of something unusual happening in the asset class. So starting with chart number 1, which is the top level view, the bar on the left represents your portfolio, and you can see that the total return for the quarter is comfortably within the forecast. So that's a good check. You can see that public equities and public fixed income is also well within the forecast. And fortunately, glad to see that all the numbers obviously being on the upper side, being positive. A word of caution about alternatives. We normally don't talk about alternatives returns over 3 months horizon. There's a good reason for it. So what we show here is more for completeness, more just to frame expectations, but these are the state street returns on a accounting basis as recorded as of now. We actually expect these numbers to change. We know that private managers restate the returns, sometimes with significant lag. So take these numbers with a grain of salt. That said, again, you see that our risk forecast connects with the performance for this quarter in chart number 2. It gets a little bit more interesting in chart number 3, where we look at the public equity sleeves. You see a small deviation, not huge, and it's developed ex-US in the middle of the chart. You see that the performance, it's a positive outcome. Obviously, the performance exceeded our risk forecast, not by a huge number. It's not reason for concern because, as I mentioned, there's about a 15% probability to exceed and 15% probability to undershoot. So you expect this to happen from time to time. The reason for that is Europe, European performance, European markets. Part of it was the China reopening story, so a number of European countries, Germany being notably more export-oriented, so they depend on the China consumption. Part of it is more of a value bias in European stocks, and value obviously performs better in a high interest rate environment. Part of it was the US, what's called mini banking crisis, which Steve just talked about. But Europe performed better in this quarter and exceeded these forecasts. But again, we're not talking about huge numbers. And in the public fixed income side, chart number 4, you see that, well, first of all, these forecasts are low, much like we mentioned before. Public fixed income doesn't come with a huge risk expectation, but the performance were firmly within the forecast, nothing unexpected. So I would say it's a check for this page. Moving to the second measure of risk, active risk. So as I mentioned before, active risk for your portfolio stands at 2.2%. And just to remind again, active risk is the expected excess return over the next 12 months. What this chart shows you is the evolution over the last 12 months of the components of this active risk. One thing that jumps at you, it's all about private assets, right? And that's not surprising because we benchmark, for example, private equity against the Russell 3000 with a lag. Clearly, private assets perform very differently in terms of valuation, frequency of markings, and we don't expect them to follow. So there's a certain tracking error. So there's a lot of active risk. Probably more importantly here is the low level of risk in the public markets. And that's again by construction. And I see it as a check, as a confirmation of the investment process across all 130 managers. Most of this risk is concentrated in the public equities. Again, the majority of US exposure is indexed. And you see a very thin orange band, and that's public fixed income. You see this band being negative at the beginning of the year. And that's simply a reflection of the positive stock-bond correlation about a year ago, which is historically unusual, but not unprecedented in high inflation environment. It's hard to see, but take my word for it. It's shifted to the positive. You can barely see it. It's a very thin band. And that's because the vast majority of your fixed income managers are passive. And those that are not passive take a very small level of risk. Again, it's as expected. It's a check. It's a good thing. And finally, you see a very thin red band, and this is cash. And that's somewhat unusual. It's almost like a free lunch in the current environment. Low risk, high return. Unfortunately, comes with very heavy trade-offs for the economy and the markets, so it's probably not likely to continue. But as of right now, cash is a meaningful contributor to the active risk. So what is this active risk? How does it connect with the performance? Again, it's the same exercise we did for total risk. The purpose of this exercise, again, we want to confirm that our risk models are capturing the exposures correctly. It's important. But also, it's a check on your managers. So it's a high-level view across all of your managers, and it's an information that they're not doing anything that you don't expect them to do. The same presentation as for total risk, starting with the high-level portfolio view, chart number 1. You see that all triangles, the performance is well within the risk forecasts. The usual disclaimer for private markets, it's information only, and we expect these numbers to change going forward. The numbers will be restated, so that's only to be expected. But look at chart number 3, public equities, you'll notice something interesting. So that's where you notice the developed ex-US just jumps off the page, right? And I keep saying there's a 15% probability to exceed these forecasts. Here we exceed these forecasts by a huge margin. So that's somewhat unusual. It's something that we'll look at, something to look into, it's something to check. So you have 8 managers in the public equity portfolio, and about 18 emerging managers that have a much smaller allocation that do not really drive the risk exposures. I'm happy to say that all of active managers delivered a positive outcome. So we're in a public session, so I'm not allowed to mention any managers, so I'll keep it anonymous. But 2 of your managers delivered an outstanding performance, more than 7% of excess return for the quarter. And that was driven, and we have John in the room, so he'll take the questions, but it was driven entirely by the existing exposures. These were the stocks, the exposures the managers took long before the beginning of the quarter. It's mostly in the technology sector, to some degree industrial, but they represent long-held views, so there's nothing unusual, unexpected. It just, the conviction was aligned with the markets. So again, it's a good outcome. And finally, in the public fixed income side, chart number 4, you can see there are no takeaways, and again, it's a good thing. So everything is functioning as expected. The performance, the excess returns were comfortably within the risk forecasts. So far we talked about your portfolio in the past terms, right? So this is what portfolio did in Q1 of last year. What about the future? Right, the future is always what concerns us the most. And nobody knows the future. So I don't want to pretend I can give you all possible outcomes of the future markets in your portfolio. That's not going to happen. What we can do is look across the main drivers, main factors that may affect your performance. And the main kind of dimensions of risk are kind of obvious. It's the stocks, equities. Obviously, your portfolio is driven by equities. It's the rates. And obviously, within last year, rates was the talk of the town. Everybody's talking about interest rates. And finally, the commodities. And commodities are the bloodstream of the economy, right? So until the economy shifts fully to artificial intelligence, information technology, even then we need power. As of right now, it's all about building the factories, transporting, producing energy. So commodities are important. And within each of these 3 buckets, we picked 3 most important markets. For equities, it's easy. It's obviously the S&P, the emerging markets, and the European stocks market. So these 3 indices together make almost 3/4 of the global equity capitalization. Within rates, by far the most important rate is currently the US Treasury, what the Federal Reserve is doing. And the best proxy for that is actually the 2-year Treasury rates. 2-year Treasury rates incorporates the Fed fund policy rate and also the market expectations about the future. The 10-year Treasury yield is important for the real world economy. That's what sets the mortgage rates, that will sell corporate borrowing, and not just domestically, globally as well. And the US dollar. US dollar probably the most important FX rate for anybody, right? It's obviously it's domestic currency, but it's a global problem. And here represented with the euro-dollar exchange rate is probably the most important exchange rate. In the commodities, we picked 3 markets. First of all, copper. Copper is the proxy for GDP. Almost everything being manufactured, be it the buildings, the roads, semiconductors, computers, everything takes copper. So copper correlates highly with the GDP growth. Oil is important. Oil goes into everything, likely or not, but as of today's economy runs on oil. And of course, inflation is the talk of the town. So for these 9 market factors, we present 4 years of history. And we use 4 years because roughly it coincides with how our risk system looks at the world. That's about the extent of history that the risk system takes in. And I just like to pause for a second just to look at these charts because I think they tell an amazing story. I think it's a story people will be studying for many years to come. Look at the S&P, chart number 1. You see the COVID dip in the early 2020. You see a very strong recovery post-COVID. And large part of this recovery was driven by the stimulus. Almost $5 trillion were pumped into the economy. We see the strong performance in the markets. We see low level of unemployment. And hopefully we may expect soft landing in the future. But it was a strong success of the policy. We see the same shock in emerging markets, same COVID shock, but you notice that the recovery was not as strong. And that to a large degree is China. It's a story about China, the lockdown, and a very slow and lackluster recovery, which that can be a separate conversation story. And of course, Europe, right? So we just talked about strong performance of Europe in Q1. But post-COVID, they didn't have the same fiscal stimulus, and it shows in the numbers. The recovery was not as strong in the stock market. In the rates, again, chart number 4, you see a very strong drop post-COVID as the Federal Reserve tried to stimulate the economy, followed a very unprecedented steep line going up, just like Steve was saying. And that, of course, corresponds to the strength of the dollar. Right, chart number 6, which is good for us, not necessarily good for the rest of the world. You see very strong dollar rally, which we gave some of it back in the past few months. And finally, commodities, copper, again, you see the same COVID dip. You see rally in the copper prices as people get more confident in the recovery. And then it stalls. And to a large degree, again, it's about China, because China manufactures a lot globally, and lack of demand pushes down on copper prices. And some of it also applies to oil prices. Obviously, you have a strong squeeze after COVID because disruption in the supply chains, but also impact of war in Europe, Russia-Ukraine war had a little bit unusual impact. It drove prices high in the beginning, and now unfortunately I have to say it drives prices down as Russian oil is capped at $60 per barrel, and it still finds ample outlets in Asia. It's still being sold in the market. So for each of this market, we show you how our risk system projects the future outcomes. So here we show the worst expected 1 month's move over the next 12 months. We don't know if this move will happen. We don't know if it will be up and down. All we know that all of these moves have the same likelihood, and that's important. So you can see, for example, in equities, the most risky market right now is Europe. So you see that it's a 31.5% per shock versus 26.5 for US stocks. That's actually unusual. US equities tend to be more risky over the time. So we lived through unusual times. There was a lot of market volatility. There's a lot of uncertainty. And that's why you see that our forecasted market shocks are very wide. Like, for example, for 2-year treasury yields, we forecast a 1.5% shock either up or down. That's a lot. So what does it mean for your portfolio? Yep, the next page, please. So here we present the same 9 factors. You see the market shock on the left. And much like we talk all the time, there are absolute returns and excess returns. They're both important, but they give you different parts of the investment process. Let's start with absolute returns, chart number 1. Here we present 2 scenarios, risk on when markets rally and risk off when markets sell off. The important thing to keep in mind, all of these stress tests are equally likely. So as you look at the magnitude of a response, you can tell which will produce more damage or benefit. Starting with equities, you see that the most important exposure in your portfolio is the S&P 500, your stocks. And you can say it's by construction, yes, but also you notice that exposure to Europe is actually not that far behind at 15.5%. And why that is so? Because a lot of American companies derive large part of their revenues from abroad. A lot of companies at S&P are multinationals. If you think about Apple, yes, it's an American company, but manufacturing is not domestic, and a lot of sales are also not domestic. So the important takeaway from the first three lines from the equity bucket is, first of all, your most important market for you is the S&P. So that connects with the asset allocation, connects with the manager selection, and again, it's an affirmation, so no big surprises. Also, your exposure to China is low. And I say that because line number 2, MSCIM, is mostly about China. And again, it's a separate discussion, but what China economy is going through right now is probably not a bad thing to have lower exposure. Like China is restructuring, it's slowing down, and it's trying to stimulate the economy. So the future, again, is a little bit uncertain. Second, in the rates bucket, the green band, you see that your exposure to the Fed fund policy is actually very low. That's line number 4. It's only 1.2%. Where you expose the most is the dollar exchange rate. It's the strength of the dollar. And actually, the weakening of the dollar is beneficial for the portfolio. And finally, in the commodities, it's all about copper. Because remember, I mentioned that copper is a proxy for the GDP growth. So if you bring it all together, it tells you a consistent story. So your portfolio is positioned for the global GDP growth, be it through exposure to the S&P 500, be it through the dollar exchange rate. Declining in the dollar exchange rate stimulates global manufacturing, be it exposure through copper or inflation. The growth in the global GDP is beneficial for your portfolio. Again, I hope it's not a huge surprise. It's consistent with asset allocation, but again, it's an affirmation to your portfolio. Secondly, you'll notice there's a small asymmetry between the risk on and risk off, which we call passive convexity. It's actually a good thing. So your portfolio benefits more from the upside and loses slightly less on the downside. It is actually different from what I mentioned to you last time. Last time we didn't see much of it. It's not something that your managers do. It's a result of asset allocation, but mostly it's a result of the markets. It's a result of the correlation. So I wouldn't be surprised to see this convexity go away, as we saw it last quarter, where I would get more concerned when the convexity turns to be negative, meaning you lose more on the downside than when you gain upside. That will be a point when we need to look into it and get more involved and have some conversations. But as of right now, it's actually moving quite well. You also notice that the excess return, column number 2, are fairly low. And again, that connects with what we talked about before about active risk, connects with our expectation, connects with the majority of your managers being passive managers. So under these hypothetical forward-looking scenarios, we do not see any excessive risk-taking. So again, it's a positive outcome and it's consistent. And finally, you can see that your portfolio is positioned pro-risk. So you're taking slightly more risk than the benchmark. And it runs across all scenarios, again, it's consistent with our past observations. And now that we've done it for a few quarters, we can actually look at the history of these exposures. Can we have the next page, please? So here we show how these exposures, these stresses evolve over the time. Again, it's important to understand because it's yet another check on your portfolio. It's another lens how we can understand if something unusual happening in the portfolio. And broadly speaking, it's all evolving without big jumps with a single exceptions. If you look at chart number 1, the black line, the exposure to Euro stocks, is actually a significant increase in the previous quarter. And that's something that's actually happened because of your managers, with repositioning of the managers. Nothing unusual, but the repositioning within the portfolio created a small increase in the exposures. The rest of it is due to the market drifts. It's the change in correlation, change in the asset classes, how they interact with each other. So you can see chart number 2, this is small upward drift in exposure to rates. Chart number 3, exposure to inflation slowly coming down. But slowly is the key word here. There are no big jumps. Again, it's a mature portfolio. You don't expect any significant action. And again, to me, it's yet another check that everything is working as expected. And finally, just to conclude, just take a look inside the portfolio, what's happening in these forward-looking scenarios. Give me the next page, please. So here we show the action at the individual asset class level, how they respond to each of the stress tests. And I probably will not break any big news. So when we have the equity-led rally, which is chart number 1, the majority of the response comes from equities. You do not get much of fixed income contribution. It's a little bit more even in the rates and commodities driven stresses, chart number 2 and chart number 3. You see that all asset classes contribute more equally. Again, keep in mind, all these shocks are equally probable. And final, last observation, there's not that much diversification within the portfolio. So the only place we see diversification, by diversification I mean the opposite moves of the asset classes when they can cushion the shocks. So you can see chart number 3, where core fixed income provides small diversification being a negative contributor. Right, so I'll stop here and open with any questions.
Any questions from trustees? Any questions from any of the trustees that have joined remotely? Larry Bosley?
Just a quick question. When we looked at Steve's charts, convertibles didn't do that well, but it appears you're assuming that convertibles will do better as we go on as I'm looking at your charts.
I wouldn't necessarily say I expect convertibles to do better or worse. I wouldn't say it's about expectations. So convertibles, obviously, it's kind of crossover asset class, both feature of bonds and equities. It's also a very technical asset class. It's driven mostly by issuance and by the volatility levels in the markets. Right? So broadly speaking, I would expect convertibles to behave somewhere in between high yield and investment grade, somewhere there, comparable to high yield. I'm hesitant to make projections for the future.
Robert, do you have anything you'd like to comment? Okay. So as we have this broader conversation about asset allocation, I suspect that we'll be having a fairly lengthy conversation about a bunch of different assets and types of investments. And I would encourage trustees, if there are asset classes or specific types of investments that we either have, haven't had, or had in the past and don't have today that we'd like to explore, I think now is the appropriate time to either alert Callan, alert the Bureau of Asset Management, alert both it's probably the best course of action, and have those scenarios run with all of those investments. And every time we do an asset allocation, for those that have gone through it before, we always look at different asset classes that we don't necessarily have today to see if they're a fit. I think back over 20 years, a conversation about timber, a conversation about whether or not we should be in commodities, all of those things, appropriate conversations to have during a strategic asset allocation. And I think BAM welcomes to have that conversation, and also welcomes researching products that the board thinks may add value at the end of the day and provide for a strong portfolio. So any anybody who has any ideas about things, now would be the time to kind of do that. Run the analysis, run the appropriate metrics, have the consultants look at it, have BAM look at it, and we may have the expertise already in-house, and we've just never explored it, and it may also cause us to rethink things. So those are things that I think are important conversations, and I think we should have those as we go through this process. And this process is not driven as much by BAM and the consultants as it is by the board too, right? So we need to be engaged as well. So that's my 2 cents on it. Yeah. But I'm just looking at the board. I see no additional questions for the risk folks. I believe that concludes the public agenda. So with that, I'm going to make a motion that we exit public session and enter into executive session.
Second.
Okay, all those in favor, please indicate by saying aye.
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 All right. Opposed? Any abstentions? Hearing none. Motion is carried. If BAM could tell us when the recording is stopped. Great. So we are now in public session. So I believe that there is, Mr. Chair, if you don't mind, there's one issue to discuss in public. So I'll turn the floor back over to you.
Great. Thanks very much, John. And hello, everyone. I believe the item that remains to be discussed in public is the adoption of the finalized budget documents for fiscal year 24, both the PS and the OTPS increment. Is there a motion? We can have a discussion once the motion's been made and seconded.
So moved.
And I will second that in order to indicate that the controller is prepared to move forward.
All right. And moving on to discussion, would anyone like to make any comments on this item?
Yeah, just a quick comment. Last time we spoke about this on the board, I was a little upset, and I'm still a little bit upset that Melanie didn't get all the personnel that she needed. And I understand there may be issues with the budget. However, the sort of aside or inferred, what was inferred was you got to make do with what you have, but we still need you to get everything down to size and you have to report to us, and we need to make sure that you're doing what you're supposed to be doing. I thought that was a little unfair. I still think it is unfair. You can't not give somebody what they need and then ask them to have things done in a timely manner. They're, of course, always going to do what they have to do. They have been doing that. They've been consistent in that. And I just wanted that to be on the record. We can do budget modifications, as you pointed out. However, those take time. And this whole process has been a little bit disappointing to me in that she made clear months ago that she needed a certain amount of personnel and that it would take time to get them on board with RFPs, hiring, and then the training portion would take time. So these numbers are going to continue to climb for our members, irrespective of what we do at this point. And I just don't want them being blamed for that. That's all.
Yeah, thanks very much, Larry. I mean, to be clear from the perspective of the Mayor Adams administration here, it's not a matter of blame. It's not a matter of, I mean, maybe it's a matter to some degree of unrealistic expectations, but it's also just a matter of what is possible. And this, I think, represents a very reasonable construction of what is possible in this environment. And it is just the case that the fact that an agency doesn't get the full allotment of what they would like in a budget, that the agency just still has a core mission to fulfill. And I have no doubt that Melanie and her staff are going to do absolutely the best of their ability, as they always have, to fulfill that core mission and to try to deliver the best results they can with what is available today under this budget. I appreciate your concerns very much, Larry. They are not lost on me, but this is the climate that we're in. And in a situation where new resources are becoming available, even if it's not the full extent of what you'd like, there have to be expectations associated with that. And so we are very eager to see the work plan that we had discussed at the briefing. I'm curious to know the status of that, but your comments are not lost on me, Larry. I hope that that's clear.
Yeah, and I hope that you don't take this personally, because it's not on you. And as I spoke to John, the only thing I'm concerned about at this point, since there's nothing else we can do, is that Melanie and company not be thrown under the bus if the timelines are not met, if she can't get the numbers down in what the mayor or the controller think are reasonable amounts of time with the personnel she has. That's my concern now. John has already spoken to that.
Yeah,
and said
and
that's not going to happen.
And I'll just say for the record and the benefit of the group, that is not the intention, is to throw Melanie or anybody on her team under the bus. I think the belief is that given that we look at all the budgets from all 5 systems, and we are unique in the city and the controls office from that standpoint, we looked at the budget. We think that the agreed upon number of individuals, I believe it's 13 plus 3, is 16 in total, is the appropriate amount. We are always open to have a conversation with everyone at the table, Melanie and her staff, if that appears to be an unreasonable number of people and we need to have a broader conversation. We're always interested in having that conversation and discussing a budget mod. The fact of the matter is we've tried very hard in this cycle to have an open dialogue with our colleagues in the mayor's office in order to ensure that that we were both committing to what we thought were, or both our offices agreeing to what we thought was reasonable. And we did have some discussions, admittingly, between the mayor's representative and Allison and myself, as appropriate, as the mayor or the controller must approve the budget here in order for it to pass. And I think we had some very good conversations, and I think we all came to a place where we think that an adequate number of people will be committed to enhancing the operations at NYCERS. And I trust that if there is an issue where more folks are necessary, that Melanie will raise that issue at the appropriate time, and we'll discuss that. I don't think there's any intention of placing a blame that doesn't exist on anyone at this time. And I don't think there's going to be a situation where we're going to blame anybody for this. I think the reality of the situation is we are okay approving a budget in the context of the broader city, where the mayoral administration has time and time again asked agencies across the city to work within the budgets that they have. We are increasing the budget here. We think the ask is appropriate. We think that we're actually hopeful that the heads that are being provided will help to shore up the option letters, and we think providing 3 extra heads at the discretion of the executive director and her leadership to put those folks in positions that will enhance the agency is the appropriate way to go at this time. So we recognize that nobody loves the budget process. I think I could speak for Brian when I say we don't love the budget process on the city side as well, but we think that we've come to a place, and look, we respect the hard work that everybody at NYCERS does, everybody. And we know it's not easy, and we know that from time to time when people pick up the phone and they're upset because something didn't happen yesterday and is going to happen tomorrow, we completely understand that. And we do feel for the folks on the other end of the phone that have to hear that. So we are mindful of that. We think that the collective 16 additional folks is going to help and go a long way towards helping to alleviate some of that stress. So those are my comments with respect to the budget.
All right, thank you very much, Mr. Dorsey. Would any other trustees like to be heard on this? Mr. Santander.
Yes.
I want to thank the mayor's office, and I want to thank the controller's office and fellow labor trustees and all trustees for their input on this process. And we hope and we expect that, and we know that NYCERS will make the best use of these resources, and we're glad that these resources are being provided. We look forward to progress in reducing times, and again, we thank the board and trustees for their consideration. We thank the mayor's office and the controller's office who deal so much with the city's fisc. So on behalf of Executive Director Henry Garrido, we look forward to progress in this area. Thank you very much.
Thank you very much, Ray. Dave, did you want to say something?
No, but I was going to have a point of order when the declarations cease.
Well, the declarations have not quite ceased, because I did want to say, and to reinforce the clear consensus that it's not about blame, I wanted to thank Melanie and Liz specifically and personally for the work that they put into this, for all the inquiries, all the many inquiries on this subject. And I want you to convey that to your staff as well, because I know that there was a ton of work done behind the scenes to have to deal with some of the deadlines and some of the questions, and some of the questions that were not terribly unlike other questions. And I really do sincerely appreciate it. And it's only with your work that we got to the place where we are today, imperfect as that may seem. And so now, Mr. Katzman, your point of order.
Thank you. I believe we have actually two budget resolutions, one for the administrative budget and the other for the loan budget.
Oh, yes. Thank you very much, Mr. Katzman. I had not addressed the loan budget separately, but should we? Yeah, does the motion and second work, or do we need to? All right, so
I believe that there's a motion on the table to adopt the administrative budget. So let's move that.
Great. So I think at this point, the discussion is concluded. All in favor of the motion to adopt the fiscal year 24 administrative budget on the terms presented by in the budget book, please say aye.
Aye.
Aye. All opposed, please say nay. Any abstentions? Hearing none, the motion carries.
And I'd just like to point out for the record that the mayor and the controller both agreed to the budget, so we satisfied the clause of the administrative code that requires either of us to vote in favor.
Thank you very much, Mr. Dorso. So that
R3.
Thank you very much, Ms. Winery. So that leaves one item helpfully pointed out by Mr. Katzman, and that is the adoption of the fiscal 24 loan budget. Do I have a motion to adopt that item?
So moved, John Dorsa.
Is there a second?
Second, Larry Bonds.
Is there any discussion on the loan budget? All right, well, all of the statements that I previously said, I hereby reiterate. Otherwise, I have nothing further to say. And is everyone in favor of the budget? Please say aye, the loan budget.
Aye.
Any opposed? Please say nay. Any abstentions? Hearing none, the motion carries.
R4.
And I'll also note, as I did on the previous resolution, both the mayor and the controller concur, so we have satisfied the requirements of the administrative code.
I'd like to thank the board for their support of our budget requests. We will be coming forward with a work plan that will reflect the hiring and training time and where people are hired from within the same unit, the backfilling and training of those, because you won't see the full complement of the increased FTEs until the backfills are hired. But we appreciate the support of the board. We will hold ourselves accountable to show you the progress we're going to make with the additional resources, as we have done every month with the call center. And I'm very proud to report that Yesterday, the call center answered 100% of incoming calls, and that we've been consistently in the 90 percentile for the last several weeks. So we will continue to show that type of progress once the positions are hired and filled in the retirement process and other areas where the board supported us with additional resources.
Can I just say, it's not just confidence in the budget, it's confidence in you and your staff as well. So I think that should be conveyed in this as well. And I think I speak for the board when I say that.
All right. Well, I believe that concludes the items on the public agenda. Is that correct, Melanie, or no? Is there a
No, I
report
need
out?
to do the report out.
Thank you very much, Ms. Winery. In person, this is.
Okay, the board agreed to commit funds to a private equity and a real estate investment, the details of which will be disclosed at a later date.
So with that, I'd like to make a motion to adjourn.
I second.
All right.
Aye.
All in favor, please say aye.
Aye.
Opposed? Abstentions? Hearing none, the motion carries and we are adjourned. Thank you, everyone.
Thank you. And Wilfredo, you can